Good morning and welcome everybody to today's webinar on livestock risk protection. I am your host, Amanda McLean, the Farm Management Specialist here at North Dakota Farmers Union. A few housekeeping tips before we get started. This webinar is being recorded, so if you'd like to watch it later, you can find it on the North Dakota Farmers Union YouTube channel. Everyone is on mute, but if at any time you have any questions or comments, please feel free to type them into the chat box below, which you can find on the chat function below of the Zoom call. Also, there will be time for Q&A at the end of today's webinar. With that, I would like to turn it over to our experts on livestock risk protection, or LRP. First, we have Farmers Union Crop Insurance Sales Director, Denny Stratton, who is located in Minot, North Dakota. Denny has been working with North Dakota Farmers Union Insurance for the last 19 years. He first started as an agent in 2004, and then in 2010, he has been working as management. As the crop insurance sales director, he works with agents in North Dakota, South Dakota, Utah, and Arkansas. Also, we have Zach Axman, who has been a Farmers Union insurance agent for over 10 years and is currently located in the Rugby office. Zach is an expert on livestock risk protection and has been selling it for over 9 years already. I will turn it over to you now, Zach and Denny.
Thank you. We'll just go ahead and get the PowerPoint pulled up here and we'll start going through kind of some of the options and the nuts and bolts of how the policy works and pros and cons of it. There we go. We're going to start off with just some basic definitions of what is LRP. Really, it's more of a form of protection. LRP, it's a policy that's designed to protect producers from declining livestock prices. It's that simple. It provides coverage. You can put it on feeder cattle, fed cattle, and swine. It's available all year long for ranchers with an ownership share in the eligible livestock I just stated. And we'll get a little bit more into that here in a little bit. The thing I like about it is a subsidized insurance policy, like you might hear with crop insurance. It's really there to provide a safety net and put a floor on your calf price. We tell people, try to think risk management with this. This insurance provides protection against downward price risk during the insurance period, but really no other perils are covered. There's no mortality, anything like that a lot of people sometimes make assumptions on. Let me minimize this real quick, if you're okay with that. Okay. Coverage prices, you can guarantee your coverage based on a price, and they're usually range from 70 to 100 of the expected ending value of what you would sell your calves for. That's the safety net you have. If your actual endorsement price is less than what you're covered for, then you're protected. It's that simple. Insurable livestock, I started with the most common one here, and that's the feeder cattle. Usually it goes all the way up to 600 pounds for steers and bulls. And that's mainly if they're unborn, but you can also go up to as far as 1,000 pounds for steers only. Same thing with heifers. So when people are doing an expected ending weight, they'll tell you which one they're kind of leaning towards. Also, there's the specialty varieties here, dairy cattle, the Brahmins, like I said earlier, the unborns. You can insure them right before they hit the ground, but the problem is you're limited to 600 pounds on them. The other two kinds of livestock we see, they're not nearly as common. Fed cattle, there is some policies being sold on these because it does actually work well with them too. We can go all the way up to 1,600 pounds on them on the different grades and yields. Swine, I won't get too far into because it's just not, it's available for anybody who's interested, and we will be happy to cover that and go into it with anyone who wants to call or have any questions on it. But right now, we just don't see or hear as much demand for that one. Where can you purchase this? You can get LRP through any private insurance agents that are able to sell and service crop insurance products, and they've had the required livestock training and certification. It is a requirement for all agents who do sell this to go through the required hours of training and to make sure they pass their tests and understand how the policies actually work. I would say the best agents to talk to are anyone certified and currently working with it now, the ones that have actually been in it or around it. Who is LRP for? I start with feeder cattle eligibility because that is the most common one. Guys like Zach actually seem to sell. So it's available for feeder cattle. They'll be marketed and ready to put in a feedlot for fattening. If they're under 1,000 pounds or less, then they're in that weight range that they're eligible. The other thing though, you can only insure cattle for which you have an ownership share. There's some different contracts people have out there, but it's not really in writing or on paper, and that's a no-no. You really can't cover that unless you have proof of your ownership there. How does it work? Different coverage prices, they're established by the type and weight, all those varieties we showed you here a couple slides ago of those feeder cattle, and they use price adjustment factors based on those weights and what type it might be versus, steers versus heifers, things like that. 600 pounds and less or 900 pounds and less, there's different classifications for them. You can share any combination of those though, of types and weights that you have an ownership share in. So it's not, you don't have to be pigeonholed into just the one if you have more than that.
Yeah, you can write a bunch of different endorsements on it based off of steers, heifers, even the unborns. You could do, X number of your herd as unborns, and then once you have them on the ground, as long as you don't go over the total head you have, you could do steers and heifers later on too if you wanted to split them up that way. You don't have to do them all at the same time by any means.
Yeah, it doesn't really matter on that as long as it fits those parameters, you're okay. And at the end of it, a claim is payable if the ending value is less than the coverage price. It's that simple. So, go ahead.
The actual ending value is a weighted average of feeder cattle, and it's calculated by the CME, or the Chicago Mercantile Exchange, for cash settled. The commodity index price is multiplied by the applicable type, weight, and price adjustment. There are a couple price adjustments that take place, like steer weight ones, which is 600 pounds or less, is actually at 110%. And they figure that at the beginning when we quote it, and then when they at the final ending value, they also take it times 110%. Heifers at weight one are 100%, so there's no change in that. Unborn steers and heifers, they use 105%. So once again, they take it times 105% at the beginning, and then once the ending value is figured out, they take that times 105% as well. Steer weight twos, which is 600 weight or 6 weight to 9 weight, steers are at 100%, heifers are at 90%. So you got to remember, I don't know if you're watching it, when the claim comes through, they are going to adjust it just like they did at the beginning.
No, I think the thing to take away from that is a lot of people kind of focus on what they're selling at their local livestock at the ring there. And it really, this is based, similar to crop insurance, it's based on, Chicago. It's going to go off those prices and those indexes. Okay, so here's the different coverage levels you have. Believe it or not, for years, we've heard people, ranchers and producers always talk that, I wish there was a product that was similar to what farmers get for crop insurance. And finally, we're actually getting there now. I really do like the system. The premium is subsidized. So what we're getting at is it's actually shared through RMA. So you're not paying full premium. The subsidy factors are the percentage that is being covered for you as a producer to help make it more affordable. They really want people to buy this because this is more of a feasible and sound program to keep our producers strong and going. It's better than any form of what do I want to say, maybe ad hoc or disaster program. It's really hard for people in our government to budget for that to help keep our producers going strong. So you can see right there the subsidy levels. They actually decrease as your coverage goes up, but Zach will show you in a little bit. Don't let that scare you. That's actually not such a bad thing. So how coverage prices are calculated?
So you take the number of head times your target weight times the price, and this was based off of yesterday's prices. So you can see under coverage, if you have 1,000 head and your target weight is 7, and the weight or the price at 220, I believe would be out to about November right now, you'd have a total guarantee of 1,540,000. Your actual ending, your number of head doesn't change, your target weight stayed the same, and it actually ended up at 210. So you would have a lost payment of roughly 70,420 coming forward. And you know, that's I always tell my insureds, I don't have any say in the price. The company, we don't write it through. It's essentially RMA just telling the company, yep, there's a loss if anything's below this price. So it's nothing that we can do or the company can do. It's all based off of RMA's jurisdiction on the CME when they come up with that price. How to buy. So the insured can select a series of periods and weeks that range anywhere from 13 weeks all the way out to 52 weeks. Now, with that being said, that is not given every day. So it all depends on the market. As the market fluctuates, RMA will pull, they could pull and only give 13 through 39 weeks. I've seen it where the market started to go down and they only gave us 13 weeks, where 3 days prior, they gave us all of them. So when you're looking at marketing this, it's really important to, you know, everybody wants to buy it at the very top, and I agree. But the problem is once it starts to drop and you've hit the top, they'll lock us out, and we do not know a definite time as to when they will give us those options back in. Just last week, I had an insured that wanted to lock in out to November, and there was a little drop in the November, December, and January, and they locked us out for 3 days before we could get back in. So, you know, locking in at the top is always best, but at the same time, if you wait too long, you can also lock yourself out. LRP feeder cattle and fed cattle limits are 12,000 per special coverage endorsement and up to 25,000 per year. Swine is maxed out at 70,000 or 750,000 per year. And like we've said before, this is not there are no sales closing dates or anything like that. This is every day other than holidays where the markets are closed. Continue on.
Yeah, as you can see, it's flexible. I mean, being able to buy out that many, when you can kind of pick the time you want to hit your target weights and sales, there's a lot of options there. And there's a little flexibility there too. If you accidentally sell a little too early, maybe things like that, right, Zach?
Yep, absolutely. So benefits of LRP, you have a guaranteed price. You're locking in a floor, is what I always say. When you're doing that, you know, that's the lowest you're going to get as far as that goes. You know, the other side of it is I've never said or ever that I'm, you know, as far as puts and calls and stuff like that. The other nice thing about this is once you get this policy, we're not going to be calling you saying you owe more money, because once you lock it in, that's what it's at. You know, and you can do any number of head covered up to the limits. Numerous period options that we just went through. That's all depending on the market. Wide range of weights at other other marketing options, it's your estimated market price or market weight.
When you say any number of head can be covered, have you run into any situations, I feel like you have, where we've had a customer that say picked 100 head to insure, and then after the calves were born or whatnot, they found out that they were less than, maybe they were 85 or 90, anything like that?
I guess I haven't, because whenever we do unborns, we try to figure in a mortality rate, usually between 2 and 5% on that. I have had it where guys have decided only to do 50% of their head, and then a couple weeks down the road they decide they want to do the other 50%. So essentially they're insuring their whole head, but over the top of 2 endorsements. And the producer, and when I go through a quote, I'll show you what the end date is. Everybody likes to get within a certain time period of when they sell, and some of the changes that they've made, they have made it more user friendly. They went from 30 days prior to the X date to from 60 days, or from 30 days to 60 days. So you could sell them 60 days before. So it gives us a little bit more time to play with on that as well.
Really what we're getting at is those are a few different benefits. One thing too, a lot of people have been running different options out there, and from what we hear, for some people it seems to just work a little better. It's a little more cost effective for them versus running options, and it's a little safer. So
they just make sure they get that locked in, that value is what they like to normally see, because they know exactly what it's on then.
Yeah.
So kind of touch base on this a little bit in the prior slide. Modified the premium offset language to allow an insured to choose to receive indemnities without a reduced to offset premium on endorsement. This just means they have the option to take the premium out of a loss on it as well.
What helps with that is the premium now isn't due till much later than it used to be. It used to be due immediately upon payment, or as soon as you sign up for the application, I should say.
We used to have to send a copy of the check with the application to put.
Yeah, exactly. So now it's actually kind of stretched out. So those that might have operating expenses that are due immediately or whatnot, they might want this claim payment right away to use towards those other items until they do maybe sell or do something else later, and they can pay the premium later, which has really helped out with a lot of ranchers. So
they do require the insurance companies to pay the claims now within 30 days. Previous insurance companies had 60 days to pay the indemnity following the receipt of a claim. So once again, they're trying to get the money out faster on the losses.
Yeah, the one thing we try and watch with a lot of people is prices might go up. So they'll try and cancel their policy and write a new one.
So I actually ran into that where a couple months ago we wrote one, and the individual wanted to cancel his policy and rewrite it, and we cannot do that. So once you lock in your premium on it, the only other way you can write another one is if you did not do your whole farm or your whole herd, and you have head that left that are uninsured, or do you get more cattle?
More improvements. They've increased head limits. Before they were a little worried about that just because of how much liability was out there and how to budget for it. But they've increased these drastically over the years. I mean, they keep improving this program more and more because they want to make it more enticing for our producers out there to put a safety net out there and make sure that they're sustainable from year to year. So they increased head limits on all types here. And they've actually made it so you can do another livestock product with this if you really wanted to, called livestock gross margin. That one, I won't go too far into the weeds on that, but what they're really saying there is you balance out your expenses and your income with your projections, and you guarantee an income based off that. This LRP program seems to work a lot better though for the feeder and fed cattle out there. So, but they're saying you can have both. You just can't have two insurance policies on the same herd of cattle. To give you an idea of how much it's changed and improved, we did find some numbers that go all the way back as far as we could find, and just shows how much subsidies have actually changed. And they kept changing it, they kept improving it, because it just took a while to get to that spot where people were comfortable with the coverage versus premium. So the subsidies, which is government share in this, is increased drastically. So you'll see the current there. It's 10%, and in some cases there are a few spots where it was even 15, but now it's just sitting at 10% over what it improved in 2020, which had improved over 2 years prior to that, and drastically improved since it inception.
Yeah, this is definitely made, and I think this is one of the biggest things that has made it more economic for the insureds to look into in the last couple of years, especially because it's weird. I went from selling 1 or 2 policies a year, 3-4 years ago, to selling way more now, and a lot of it has to do with the subsidy on it. So here's a fed cattle, just kind of an example of how a quote comes up. So you can see we're in North Dakota, we're using Pierce County fed cattle, steers and heifers. So there's the effective date of 3/14, which was yesterday. So then you go straight below that and you find the end date of 12/12/23. Okay, so that would be the day that they use the CME to come up with the end price. So if it was below the 165.78, then there would be a loss on this. Okay. Here's a feeder cattle coverage. Same thing. It's a quote from yesterday of 3/14. The length is 39 weeks, so it takes us out to December 12th. The actual coverage price is $242.53 per hundredweight. So that gives you a total guarantee per head of $1,430. And the total producer premium on 100 head would be $46.83.
Yeah, a couple columns to look at on this, just to give you an idea here, is your coverage price, which is your guarantee, which is really nice to see per hundredweight. But then the cost per head is showing $72 per head, but the subsidized, which would be your portion after that, is actually $46. Now this is on the highest level possible, so the subsidy is not as good. If we say you chose to buy a lower level, it would be much more economical. I think at 88%, you would see a difference in premium from 46 down to under 20, but the coverage just doesn't seem to really work for most people we talk to. It's more of a disaster protection, where this is actually trying to capture market opportunity. It's kind of more of a profit insurance to make sure and guarantee your profit. And that seems to be the reason more people prefer that, when you say.
Yep. Yeah, everybody I talk to, they're trying to lock in a profit and use, like I said, they're putting a floor on it, so they know where the bottom is.
This is a little blurry, but I just wanted to show the difference here. We won't spend a whole lot of time on it. Actually, Amanda took this for us and put it in the article too for the Union Farmer, but I just wanted to show the difference here. And we got another slide that'll break this down, but this is what it was in 2020, when people were actually curious about this when the pandemic hit, because things were going all over the map and they were afraid they were going to, lose their whole operation. So we were running as fast as we could, running illustrations for them to see what we could cover them for. And we'll show this in a little bit better breakdown in the next slide here. So 2020 versus 2023, we did a 26-week term and a 39-week term. And I just wanted to see the difference in coverage and premium between the two. You'll see in 2020, they $1,008 was your guaranteed coverage, but it cost you $64 as a producer. Now in 2023, premium went down almost in half, but there's $1,591 of coverage there. 39-week term kind of did the same thing. So that just goes to show you how much they've improved this program. That's why we've got a stigma out there. It seems like now everybody says, no, you quoted me that a long time ago, or I asked about it and it just didn't work. I think the message we're trying to get to everybody is it's actually changed a lot, and it's a shame if you don't look into it, because I don't know how much better it could actually get.
And that's like I said earlier, that's one of the biggest benefits, and exactly what you said is guys that had looked into it 2-3 years ago and said it was way too much money. Now all of a sudden we're gaining more coverage for less premium than it was 2 or 3 years ago. So that's why we're seeing a big bump, and everybody's starting to actually take notice of this policy. Just some, like I tell my producers when we go through this, you can watch the market, and as it fluctuates, if it's going up, you can wait. But the biggest thing to take out of this is to remember, once it starts going down, we can get locked out of this product. It's not like a crop insurance product like hail. You can buy it any, you only have so much time. So don't wait too long, I guess, is what I'm getting at as far as that goes. Because if we get locked out, they could lock us out. If the market keeps going down, they could lock us out for weeks on end. Another side of it is we can only quote it and sell it between 3:30 and 9 a.m. the next morning. So when markets are closed. So I think I can usually get a quote by the latest at 3:30 in the afternoon. And so the biggest thing is it's time sensitive, and getting signatures and making sure everything is in by 9 o'clock can sometimes be, kind of nip and tuck as far as getting it in time. So if it's something you're serious and you're looking into, I suggest getting with your agent, giving your agent a call, and at least setting up the shell of the policy. Because then once the shell of the policy is set up, when you go in to make the endorsements, it makes it so much quicker to do, especially since, like I said, it's very time sensitive.
And I think the other thing too to remember is, just because you buy this doesn't mean you can't still market your cattle in a way that works for you. You can still contract, or you can still sell if the price goes up. We've even had some customers talk to us and say, well, I see the premium here might cost me, $6 per 100.
Yeah.
I might still lock it in, and then I might want to contract, and I might want to try and find a way to get that premium back too. And I thought, oh, that's actually a really good idea. It doesn't matter what you contract at or sell at. So these prices are based off Chicago and off those futures prices. So what you do on your own is up to you. So you can actually take full advantage of that if you wanted.
Yep, absolutely.
A couple quick resources if you ever want to look into it on your own. RMA does a really good job of keeping you informed on it. The top one there is going to show you the topics, how the livestock insurance plans work, things like that. But the second one is RMA's livestock reports, and that's the actual data too that you can get, that Zach gets for everybody. But his is probably a little quicker and more concise when he sends it to you. But RMA's got a really good setup there. If you ever just want to look at what the prices are closing out at that day and what the coverage and premium would be, they'll tell you all that. The last link there is just CME groups. That's Chicago Mercantile Exchange. That's where everything comes from. And if you go in there, you can also do the same thing. Last but not least, before Zach gets into all his wizardry with quotes here, a little disclaimer here. Remember, a lot of these claim scenarios, coverages here are all considered hypothetical. You really want some hard numbers here, definitely reach out to Zach or one of our LRP agents. We have a few others out there, and make sure it's something that's specific for your situation. Because this here, we're generalizing everything. This is intended as general guidelines. And I sent you a few links there on the last, showed you those on the last slide, but feel free to reach out to any of the resources there in the second paragraph if you do want further information. And we'll bring this back up after Zach gets into his quoter here, so that you do have his contact information or mine, and we'll help direct you if you do have any questions. So I think we have to. That's okay. That's good. Okay. Let's go back to screen share. Okay.
Okay, so this is just kind of going to be a generic quote that I can run through. I'll run through a couple of them here. So all the types, you know, what we normally see as of right now, it's been a lot of unborns, steer weight twos, and heifers. I'll just run through a unborn quote here quick. One thing I always do is I always use one head, and that kind of gives us an idea of what it's going to cost, and it really simplifies it down as to what the coverage is and what the price is going to be. So most of the time, target weight is 6 weight on calves. Unborns, usually $5.99 is where they're marketing them at, and that's the max we can do on it. So if I go out to, I'm just going to do 3 of them here. I'll do November, December, and January. So as you can see, 34 weeks out in November, we're the most we can get is 99.3%, which is $230.77. And for the most part, most of the producers that I work with, they all want to see the max, because like I said, they're trying to put that floor on their cattle so they can guarantee themselves a profit at this rate. So 34 weeks is 230.77, 39 weeks is 231.51, and then 43 weeks. So January is off just a little bit to December. So if I go in here and I click on the illustrate, let's get this pulled up. So now you can see at the 34 week window, the end date would be November 7th. So like I said before, you could sell 60 days prior to this date without having any penalty. Now, let's say you get to that date and you decide, I'm not selling these calves for that price. You don't have to. You are not forced to sell on these dates. You can hold them for next year. You can do whatever you want with them, but you don't have to sell them on that date. So the coverage price at that rate is like I said, the $230.77. Cost per head, you're looking at the $60, but the subsidized price per head is $39. So that's the producer paid. So to guarantee yourself $1,382 at the 34 weeks, you're looking at $39 in coverage, or $39 in premium for the 1,382. And then if you just look down to November, you can see the same. You're at $1,387 per head in coverage for $45. And then out to January, which is just a little bit less than December, you're looking at $1,384 for $45. So you can market and decide however you want. The question I always get asked is, do I have to sell on this exact date? No, you do not. You don't have to sell at all on that date. You have the option to sell 60 days prior to that date. Just to kind of give an idea, I will run through, we will go steer weight twos leave everything the same as 1, but I'm gonna bump this up to 6.5 weights. So once again, you can see the prices that we're getting locked in at on this, and we'll go ahead and hit illustrate. Now these would be for steers that are already on the ground. So November, you're looking at $1,429 in coverage for $40 a head. Out to December, you're looking at $1,433 in coverage for 47, and then out to January, you are out, $1,430 a head for $47 a head in premium. And just like before on the previous one, you have 60 days prior, and you do not have to sell on those dates. So that's how the quotes, and once again, that's at 6.5 weight. So I guess if there's any questions, or Denny, if you have anything else to add in on that.
No, we'll just our contact info and open up. I know Amanda said she probably has some questions.
Yeah, we can open it up for Q&A now. Again, if you have any questions or comments, please type them into the chat function below, and I will address those to Denny and Zach. So Zach and Denny, first question. When I'm looking at taking out an LRP, how do I decide what is the best timeline or the number of weeks to insure my cattle?
I guess the insureds that I work with, they all try to be within that month. It's usually a month. The questions I always ask them is, what is your target weight and when do you normally sell? And if they normally sell in November, we try to look at November. But at the same time, like I've said over and over again, you still have 60 days prior to that. So you could actually market October if you wanted to do that and sell in November.
Okay. So if I'm contracting my calves, or instead of contracting my calves, I'm selling them directly at the sales barn, should I still consider an LRP insurance policy?
Yes, because that's especially with where the prices are right now, you can lock in that price. And like I've said, kind of, over and over again, is you're locking in a floor. So you're trying to lock in your profit on them, whether you sell them direct or you sell them at the sales barn or however you sell them, because it's not based off of what you sell them for. It's based off of the CME.
Gotcha. Okay, here's kind of a tricky one. If there is a drought and I don't have enough hay or feed till the fall when I'm going to sell, can I sell my livestock before the end date of my LRP insurance policy?
So I can't speak for RMA, but I can speak for what they did in the past. In 2021, when we were hit with a drought up here, they actually did away with the 60-day or the 30-day language at that time and allowed them to sell without penalty. But that's an RMA decision that I can't speak for them. I can just say that's what they did in the past. And from that, they have, I believe, and correct me if I'm wrong, Denny, that's kind of when the 60-day language came in, was after that.
Exactly. And I put a slide on that. I don't think it's necessary. I think you summed it up quite well. I don't see them not trying to do anything to help again if we do run into that situation.
Okay. Well, that's kind of all I see for questions. I guess with that, I'd really like to thank both you, Denny and Zach, for taking your time and sharing your expertise on livestock risk protection. If anybody has any questions, please feel free to reach out to Denny or Zach or your insurance agent, and they can get you in the right direction with help. Again, this recording can be found on the NDFU home YouTube page channel. Also, we will be sending a link for those that have registered. So if you join late, you can watch it. Denny and Zach, are we able to, are you guys okay with sharing this presentation too out with others if you like.
Yeah,
Okay.
absolutely.
So that will also be found in the email with the direct link to this. And then be on the lookout for future webinars. We have one coming up on April 13th with the FSA going through some of their farm loans, and that will be at 9 a.m. Central Time. So again, thank you everybody for joining, and thank you, Zach and Denny, and everybody have a good day. Bye.
Thank you.
Thank you.